So we'll just finish off this chapter with an example. So we have a comparative balance sheet here, an income statement, and then some additional transaction information down at the bottom. All right. Again, when you create a cash flow statement, it doesn't really matter what order you do it in, but we'll just follow the order given by the book. So the book says first to look at the change in the cash over the period. So here we have a $12,000 decrease in cash. So that portion goes down towards the bottom of the cash flow statement where we have a net decrease. And this is for $12,000. Right, and this decrease in cash should reconcile our beginning cash balance, which is $49,000, to our ending cash balance of $37,000. Okay, so from here we can create our operating cash flow section. Right, technically I should create a heading here, but I'm not going to do that. All right, so operating cash flows, we'll start with net income, and we're going to adjust that to a cash basis. Okay, so first we have accounts receivables. Our accounts receivables decreased by $10,000. So for AR decreased by $10,000, that means we ended up collecting $10,000 more in cash than our revenues. So we're going to add back the decrease in our AR. All right, the next item is a prepaid expense. Our prepaid expenses increased by $6,000. So when we have an increase in a prepaid expense, it means we paid cash, but we just recognize that cash paid as an asset. So there's no actual expense here, but if we use cash for these prepaid expenses, and we're trying to get the operating cash flows, we need to subtract out the increase in the prepaid expenses. All right, so we had a $6,000 increase, which we're going to subtract. The next item is land. Land increased by $70,000. So land is an investing cash flow. And so in this case, since land increased by $70,000, if we look at the bottom, it tells us land, building, and equipment were acquired for cash. So we bought the land all in cash. So we list the purchase of land in our investing section. If we purchase something, that means we use cash. So we'll list it as a cash outflow. Next item is building. It's a $200,000 increase. Again, we paid for this in cash, as shown at the bottom here. So we have purchase of building here for $200,000. All right, next item is accumulated depreciation on buildings. If our accumulated depreciation increased by $11,000, that means we recognized $11,000 of depreciation expense in the current period. Since depreciation expense reduces net income, but it's a non-cash expense, we need to add this depreciation expense back in. So we'll add back in this $11,000. Next item is equipment. Equipment increased from 0 to $68,000. Again, we bought this in cash. So we'll list the purchase of equipment in our investing cash flow section. And this costs $68,000. So we'll take out 68. And then the last item is accumulated depreciation on our equipment. Again, if this increased, this means we recognize depreciation expense on the equipment, Again, depreciation expense is a non-cash expense. So we'll add back in this equipment, or the depreciation expense on the equipment of $10,000. Okay, so going down, we go to the accounts payable section. Accounts payable increased by $35,000. So if accounts payable increases, this means of our expenses, we didn't pay $35,000 of it in cash. So in this case then, we need to subtract out the increase, we need to add back the increase in our AR. Our AP. Okay, so the next item then is our bonds payable. So bonds payable increased by $150,000. Right, so in other words, that means the company issued bonds and borrowed $150,000 in cash. So bonds payable, since we're trying to finance the company here, this is a financing cash flow. And here we have the issuance of bonds, since our bonds payable went up by $150,000. Right, so that means from our issuance of bonds, we got $150,000 in cash. Right, so just to be careful here, sometimes companies will issue bonds to, for example, to purchase something. So if we look at the additional information down at the bottom, it tells us the company obtained $150,000 cash through the issuance of long-term bonds. So we can list this as a cash inflow of $150,000. The next line item is common stock. Common stock didn't change throughout the period, so we don't need to make an adjustment for that. And then the last item is retained earnings. Again, we could think about what causes changes in retained earnings. One of those is net income, the other is dividends. So we can just look at the bottom here. It tells us the company declared and paid a cash dividend of $18,000. Since cash dividends deal with our stockholders, it goes into our financing section. So we can list the payment of dividends here of $18,000. Okay, so then from here, we've gone through all the different items. We've accounted for all the additional transactions, so we're good to go. If you wanted to go ahead and account for the change in the retained earnings, you could create a retained earnings statement. So again, we started with $20,000. We can add our net income of $134,000. And that should get us out to our ending retained earnings balance of $136,000 after we account for our dividends. So our dividends should exactly equal the difference between these, and our dividends was $18,000. Right, and certainly if we added beginning RE to net income, it would have been $154,000. If we take out $18,000, it gets us out to this $136,000. Okay, so we've created all the different sections. Last part, we'll figure out net cash provided or used by these different activities. So if we sum all these up, right, we got $194,000 in cash from our operating activities. For our investing activities, we could again sum all these up. In this case, we just spent cash here for investing activities. So we used up $338,000. gonna move these out to the side here so we can sum these up easier. And then for our financing cash flows, we can also sum these up. Right, and then we get out to cash provided by 132. At the end, we can sum up our net cash provided or used by these different activities, which it is not doing for us. Okay, so there we go. So once we sum all these up, the net increase or decrease in our cash from all activities of 12 Dalvin should match our net decrease in cash that we calculated directly from our balance sheet. All right, since they equal, then everything should be good to go here.